much. Welcome, everybody. Welcome to Fireside Chats. Today's topic is Ask Me Anything, Investors, VCs, and Impact Funders. My name is Leslie McKinnon. I'm the Director of Investor and Indigenous Relations at Fireside Canada, and also the moderator for today's event. I'm so pleased to see so many of you joining us today. We're excited for this conversation. It is with deep gratitude and respect that we acknowledge the lands on which Foresight operates are the traditional, ancestral, and unceded territories of the First Nations, Inuit, and Métis peoples. For myself, I'm speaking to you today from Calgary, which is within Treaty 7 territory, where I make my home and my life and livelihood. These are the traditional lands of the Blackfoot Confederacy, including the Siksika, Kainai, and Piikani First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda First Nation, as well as the Métis people of Alberta Region 3, and all Indigenous people who make their homes in this region. Here is our agenda for today. We have an incredible, experienced panel today. I'll start with some introductions, and then we'll go into a brief moderated a brief series of questions from me, and then into an open Q&A. Before we dig in, I just want to say a few quick words about Foresight. We are Canada's clean tech accelerator, and our goal is to make Canada the first G7 country to achieve net zero. We're working tirelessly to position Canada as a global leader in clean technology, bringing together clean tech innovators, industry partners, investors, government, and academia to address today's most urgent climate issues and support a global transition to a green economy. We have, as I said, an incredible panel today with tons of experience to learn from today. On the next slide, you'll be able to see Danielle Graham, co-founder of the Firehood and general partner of Phoenix Fire, Brian Duarte, managing partner and co-founder of Black Tech Capital, and James Chapea, Chief Financial Officer and VP of Corporate Development at Quantum Silicon Incorporated, who is also an EIR at Foresight Canada. Danielle, we'll start with you for a brief introduction. I was so excited to get to bring you on as a judge in our Foresight 50 program last year, and it's been awesome to see you now evolve into a role as an EIR and mentor with Foresight companies as well. So I'd love to hear a little bit from you about your story and your background before we move into the Q&A.
Thank you so much, Leslie. Really enjoying my time with Foresight so far. Met one founder in particular who I've done a really deep dive with, who's been really enjoyable to work with. I do have straight red hair, but usually I have curly blonde hair, but my face is the same, so hopefully everyone can recognize me. If you know me, you know I like bad jokes, especially a solid pun. But the way that I spent my career was fully in the tech ecosystem. I started with my MBA at Laurier and got into the tech ecosystem through Communitech and the Laurier Startup Fund. So I started my own clean tech company focused on water purification, went through the ecosystem through Ontario Centres of Innovations funding, early stage angel investing, and eventually sold it to chicken farms. So that's a whole story. And then got involved closely in the angel ecosystem on the board of the local Waterloo Angel Network, which spun into a broader ecosystem engagement equation. We have Archangel, which is a Waterloo-based fund of 20 million in early stage funding, as well as Phoenix Fire and the Firehood, which are focused on women entrepreneurs from across Canada. And we do a lot of early stage investing, and we've done our first two deals were both clean tech. So very much aligned to Foresight's mission.
So great to hear that your first two deals were in the clean tech space, and maybe we'll get a chance to chat a little bit more about that later through some of the Q&A. Over now to Brian Duarte, who I've just learned is an almost 10-year sailing veteran. So would love to hear a little bit more about what you're working on and what drives you, Brian.
Sure. I don't know if 10 years makes a sailing veteran. I feel like just a rookie because most of the people have been doing it since they were kids. But I do love it. I do enjoy it. So my background has been in the energy sector. I've been in the energy sector, even in looking at alternative energy since university days, when back then we thought natural gas vehicles were going to be what was the next shift from gasoline. And I was part of a competition competing against 23 other universities. Spent the first half of my career working in the natural gas sector and then transitioned out as an entrepreneur. I was an entrepreneur since as a kid. My first business was selling golf balls at the age of 10. So I got back to my my passion. I love being an entrepreneur, started a number of different businesses. 2 were successful that I sold, 2 were not. So I had all the learnings in there. And it was involved in that smart metering, and then finally evolved into sustainability. What brought me to where I am today is I started working more with entrepreneurs, especially with the Climate Ventures group that was part of the Center for Social Innovation, is now part of Fireside Canada. And what I was seeing was that underrepresented founders, so you're looking at Black founders, people of color, women founders, and we're not getting funding. And it was the same challenges I had when I was on to my second company. We had a few $1 million in revenues, couldn't even get the banks to give us a simple loan for $100,000. So I wanted to impact that. I wanted to change that. So that's when 2 years ago launched Black Tech Capital, where we're investing in underrepresented founders in the climate tech, clean tech space. So bringing together that need to fix that funding gap, and then also looking at my background and expertise. So that's what led me to here today. Looking forward to this chat. I'm also an EIR with Foresight. So seeing some great companies, and our first investment last year was into a carbon capture company. That was carbon capture turned into useful materials like carbon fiber. So that's me in a nutshell. Mm-hmm.
Thanks for sharing that, Brian. From my own personal experience, just seeing, the wealth of knowledge and capacity of underrepresented founders, many of them are connected to communities globally that are severely impacted by the climate crisis, and that drives a lot of the entrepreneurship within those communities in Canada, and I'm sure in the US and other countries as well. And so the opportunity really is global, and the impact really is global when these companies succeed. And so the work that you're doing is really important. So thank you.
Yeah, definitely is global. We're part of our fund was named one of the innovative funds for the future by the World Economic Forum. So I'm part of that ecosystem, and seeing all the great companies around the world developing is fantastic.
Excellent. Excited to chat more about that as well, Brian. Okay. And now last but certainly not least, we have James Chapea, who is a longtime partner of Foresight Canada, who has a huge influence over our investor relations strategy and our program, and how we work with companies to provide value to them and introductions to them as well. And so, James, I know that's just a small piece of what you do in your week, so would love to turn it over to you and hear a little bit more about you.
Sure. Thanks, Leslie. It's kind of strange, actually, being normally on these things, I'm on the moderator side, so it's a little role reversal here going on. But my name is James Chapea. I've been involved in financing companies for my entire career. I have taken a very entrepreneurial perspective to it, because what I've done is I've helped to set up businesses for financial institutions. Like I set up Goldman Sachs' principal investing business, invested in private and public companies. In Canada, I've done that for GE Capital. I've been responsible for running a foreign bank in the country. So I've done everything from on the balance sheet, from debt to equity, and everything from extremely early stage, angel investing, venture capital, all the way through debt and PE. I'm also, as you can tell from this, I like to say I've joined the other side. So instead of being on the sell side, I'm also on the buy side, having gone joining a deep tech company involved in really dramatic technologies that can change the world. So I get to see not only the investment side, but what it's like to be raising capital and, like to say, get punched in the face every day like everybody else is doing it. So it brings a different perspective as to how, who is an investor? How do you talk to them? What are they looking for? And I think in one of the challenges I've seen is with a lot of the companies I work with, they just really don't understand who the investors are and what they're looking to do, which creates that challenge because you're not speaking the same language. It may still be English, but it's two sides. So that's something we work really hard on with Foresight, and to bridge that gap. But that's, in a nutshell, that's my background.
Thanks, James. And yeah, I'll say when I'm out talking to investors and different networks, when I explain the process that companies have access to gain support and readiness to connect with the investor community, investors are really excited about it. And it's really resonating that we help companies be ready to speak that language and provide the information that those investors are looking for on the other side of that conversation, sitting on the other side of the table. So that actually is a great segue to our first question for Danielle. For the guests in the room today, I'll invite you to use the Q&A function to add your Ask Me Anything questions. Feel free to use that at any point, and we will start answering those questions very soon. My first question, as I said, is for Danielle. What advice can you give to startups about setting up the data room and maybe the cap table to ensure successful venture capital financing rounds later in the life of that startup?
Great question, and so critical, and really there's so many details to building your data room, building your deck, building your cap table. It's challenging to accommodate and identify all of those in a quick call. So I've got a few little presents for a post-event email with questions from investors, key questions, key data room checklists, and pitch deck kind of overviews to build your best pitch deck, as well as some examples, visual examples, because I think that's really where, if the founders can see it, if they have some exposure to it, I think that just makes it super clear, right? If someone hasn't seen a cap table before, if they haven't seen a data room before, if they haven't seen a really clean, effective pitch, it's much harder to visualize and enable that for themselves. So I think that's a good start. And then just as an overview, the purpose of the data room is really to enable an investor to be interested enough to share and create a term sheet. And so this stage is mostly focused on kind of that early product market fit, financial models, the cap table, but it can also include some areas around just generally sought after materials, security related docs, material agreements, financials, and staff. So you want to make sure that you've at least got these pieces in place. If you prematurely share a data room, it's unlikely to trigger investor interest in signing a term sheet with you.
What do you mean by prematurely sharing that data room, just to be super clear for our audience?
Absolutely. So, investors are fine to request a few extra documents here and there, but if you don't have a kind of a substantial amount of what they're looking for, then it would be considered premature. So that's why it's important to look over an example and also the checklist.
So having a complete warehouse with all of the information is really when you should start considering sharing that information with investors. Got it. Okay, over to Brian. What should startups be looking for in their lead investors? And what can you share about your experience maybe in that role and in working with lead investors?
Sure. Thanks, Leslie. The first thing I'd start off by saying is startups really need to focus on who a good investor is for them. The thing I see mistakes over and over again, I get pitched fintech things. Clearly, my stuff says I'm in climate tech, clean tech. I'm not looking at fintech options, whereas another fund that's maybe more agnostic would be. So my suggestion first is research your investors. I heard advice the other day, and I think it makes sense. Look at like the top 20 you're going to go after. So instead of going after everyone, look at the top 20 investors and see who aligns with our thesis, who is more likely, what are previous deals that they've done, and look at that first before you approach any investor, especially when you're looking at VC funds. Then the next stage is for a lead investor, again, it's critical that they're aligned with what you're doing. So for me, when people are coming in the energy space and the climate space and the clean tech space, I can help them, right? And that's what we like to do. We like to start working with the founders, doing some mentoring, advising, so they get to know us and I get to know them. And so you want an investor that's able to work with you, that you can partner with, one that you can go to when times are tough, right? Because especially you're going to hit down times, you're going to probably have to pivot, things are going to have to change. You want an investor that you feel comfortable going to and saying to them, this is what's happening, this is what's going on. If somebody's a lead investor, they understand, especially the early stages, they're betting on the team, they're betting on the individuals that are delivering this, and secondarily on the solution. So you want to have an investor that can get you, can understand you, be able to work with you and help coach you along the way. You want that lead investor to be able to open you up to other, expose you to other investors, to strategic partners, to potential customers. So, and not every investor is going to be able to do all those things, but that's the primary thing you'd be looking for in a lead investor, someone that can help guide you and take you along the way. And the same token as the investor, we're looking for teams that are coachable. We don't, if we're going to be a lead, we don't want to be with someone that, oh, I know it all, I've got this all handled. Most of us would say pass, right? We're not here just to write a check as a being leading into this. So, I mean, again, the one company, we invested in one company last year. I'd been working with them for a year prior to doing the investment. And even though their fund was oversubscribed, their round was oversubscribed, they came to us and begged us to come in because they wanted us on the cap table, because we developed such a relationship and strategic guidance. So that's the kind of relationship you want to build, where it's a win-win on both sides.
That's a really great insight, that a venture has developed such a strong relationship that they can come and make a case to you about, what value you can provide to their company, not just financially, and that was appealing enough that you were able to go on board. So that's really a great example. James, what are some of the common investment terms you're seeing these days for startups? How does this vary across some of those earlier stages? And what do you think founders need to know if they're raising right now?
Thanks, Leslie. And by the way, if you could hit replay and re-say everything that Brian said over again with the asterisks all over it, absolutely do it. He's absolutely correct. You're pick your team. Like, they're betting on you. You need to pick those people because you're going to live with them for the next 10 years at least. And so he is so correct. But you got to show your passion. They're investing in the team, not the product. So I couldn't agree more. It's a great question about what's going on right now, because you asked Brian about leads. And I'd actually have a question. Are there any leads out there today, given current market conditions? Because the way the market has evolved from last year, this year, those that are the lead investors or historically have been seem to be choking down because they're really concerned about market conditions. And you're having all these different effects going on where in the last cycle, when there was so much capital availability, the terms are very loose. So you were able to range, they were looking for the players who they could put the capital in. And frankly, some of the larger ones weren't even doing due diligence. They would just write checks, and they were pretty loose on some of the terms, which caused issues for some of the smaller ones. Now, the smaller funds right now are having the issue that there has been mark-to-market corrections. The valuations are coming down. They're going to be questioning whether they could ever raise another fund. Some of those smaller funds in the $50 million in sub funds may not ever exist again until the next cycle happens. They may not be able to raise. So they're not some of the players that you went through that could lead in the past and may have had a thesis that they could invest may not be there at all. So terms are getting tighter, a lot tighter. Valuations are coming in. But what we're seeing is what I've seen is the impact has been felt significantly on the later stage companies because there's no exits. There is no IPOs. The IPOs are closed. They do not exist. So there's no liquidity taking place, which is causing the funds to be really concerned about what they can do and how do they get off their positions. We're seeing interesting things in the secondary market where it's not just now, it historically was LPs leading secondaries. Now we're seeing even GPs doing secondaries and leading that market. So what terms are you going to see? They're going to be tighter. The valuations are coming down. But the question to me really is even more so, can you get that lead, or you're going to be forced into doing more of a club deal where you're setting the terms and seeing who will come and play. So it's not a priced round as much as you're setting the terms of valuation. So the last point I'm going to make is I think what we're going to also see is pay to play. And this really comes in these cycles where the funds get crammed down. And so if you're not, so those that are prepared to play and prepared to invest are going to start making it very painful on the funds that are not prepared to or put up subsequent capital. So they may find their position significantly diluted. So it's not an easy time right now.
And I'm sure we'll get to that more if we have some time. We have a couple audience questions coming in. We've a few that were sent in advance, so we'll start with those. The first is maybe for either Danielle or Brian. Curious your thoughts. Is tech strictly bits and bytes and lab beakers, or do you consider new business models a type of technology also? Why or why not?
So I'm happy to jump in there first. For me, it is more, like I said, we're looking for things that are good for people and good for planet. So is it in that sustainability space? So it doesn't have to be strictly bits and bytes, but it does have to be scalable. That is the key thing when we're looking at the venture stage. Is the technology got the ability to go to large scale? And to echo on some of the stuff that James was saying, especially in this day and age, is it going to scale? Is the company going to grow to the point that you have a high likelihood of seeing that exit? So it's more on what's the business model, what is the overall approach that they're taking, and it doesn't, for me, it doesn't strictly have to be technology based.
Are you seeing a shift from an investor perspective away from, either software or technology and being really strict in those focal areas? Are you seeing more diversification amongst other investors?
I can't say that I'm seeing a lot of diversification yet. I mean, there's still the trend for looking for tech-based solutions. That's still what is very much supported in the ecosystem. So I haven't seen a lot of shift, but and again, it's back to my point before, when you're looking for investors, are they in your particular niche? So maybe you're looking at more specialized angel investors and rather than your traditional venture fund. So you're going to have to do your homework as a founder to find what fits in there.
Got it. Danielle, you came off mute. I think you wanted to add something.
Yeah, and I saw Brian went off mute first, so it's a good indicator. Yeah, absolutely. Business models are a fantastic innovation if they are truly scalable and are truly disruptive. So I think those are more the key components for me. Also, to reiterate what Brian said around like the fit with the founder and the investor. And so if you're seeing a founder come forward that has experience in a particular field, is seeing an opportunity to disrupt and innovate in that field, they're the subject matter expert in many cases. Obviously, we're applying our industry expertise and our knowledge, but also we're the investors, not the founders. And so thinking about it from their perspective, learning about what they've validated through their early stage processes. We invest really early in founders. I think this is semi-answering one of the questions around what are the top things that you look for when investing as well. And that's a really important question because that ties right into kind of what are the founders bringing to the table? Is what they're building patentable? Is really important. And that's where the tech piece comes in. But from a business model perspective, you can patent processes. It's also important to think about what is it that they're bringing to the table and how are they going to implement that? So it's not always about what they've already kind of patented and built. It's more so what can they commercialize and bring to market in a disruptive, innovative way that's 10x the legacy systems that currently exist, because being 2 or 3x better is not going to cut it, especially not in this market. And I see James shaking his head, so he's got, I'm sure, the next piece to add.
Yeah, thanks, Danielle, because it's so bang on. Like, what, as an investor, and it's to two of the questions in here, what you're looking for is my number one, and it always has been, the team. I've watched great teams take a lousy idea and generate that return I need. Now, okay, so when you're thinking about this, well, what does an investor in climate tech look like? Well, I gotta say, the first time we did this clean tech thing, and we the funds were putting together large amounts, and I gotta say there was large money placed into it. Uh, Not that long after it, in the time of investment perspective, 6 of the top funds blew up their clean tech. They just absolutely destroyed it. They threw it all out. They fired everybody and they wrote off all their funds. It was because when they did it, they were thinking, well, it's a flavor of the day. We're going to put money in it. But the bottom line is you have to be able to generate the return. The people that invest in them are looking for them to be managing and putting capital at risk. So my number one is, can this team execute on the plan? Stephen Jobs talks about, show me your passion that you can execute on this and take a company from where it is to ultimately, as Danielle said, it's not a 3 or 4x. We don't invest in, at this stage, we're not investing in incrementalism because we will get killed by the large corps. So you can't do it. You have to have that step function change. So what we're looking at is, who is this team? So I'll put one last thing on it, where we get really wrong in presentations they're giving, and I'll show you this. So if you give me, so we talk about don't judge a book by its cover. Well, guess what? Everybody judges a book by its cover. So give me a great cover, and then I'll tell you what, you can throw out all the pages. If I gave you page 1 after that, let's go to an extreme, had pictures of Bill Gates, Bezos, and Warren Buffett. As investors, do you care what comes after? Like, you'll say, how much, and where do I send the check? I am investing in that team to execute, and I know I'll generate a return. Now, think about that from your perspective. How will your team execute on this? Show that to me. Convince me.
That's such a great point. And I think that does kind of that tends to be the slide or the portion of a pitch that falls a little flat, is showing the connection between the team and the technology and their success. So you might have a great bio slide. Well, why do I care? And what does that mean for me as an investor? Why do I care about your team and what they're working on? Not just what's the market and what's the problem.
Exactly. So what? And don't give me your bio, because they don't know James Shapaya from, don't care. It's in the sports analogy. Why is this team going to win the cup?
Right.
Show that to me. Convince me. At least have a chance at it.
Great point. And Brian, I saw you nodding vigorously on that one. I mean, if I've learned anything in the last year and a bit in this portfolio, it's that investing and raising are both team sports, and the amount of collaboration in this ecosystem is pretty huge. And so figuring out how to get involved in that and be part of that is critical. And so this is a valuable session. So our next question is about, of course, the Silicon Valley Bank, which met up with a crisis due to rising interest, and this does have implications for startups. Can you comment on the availability of bank finance for startups in the aftermath?
Who do you want to take it?
Whoever is most excited to chat about financing startups.
Banking. So there isn't really debt financing for early stage companies, right? It's not, we don't want to add that level of risk. So what happened with SVB? Ultimately they had a lot of their capital that was put in bonds. Interest rates went up, their capital went down. So they had to choke down. They were going to go and try and raise money, and they went no bid. So they couldn't raise the capital, and they ended up with a run on it. Silicon Valley Bank really wasn't that active here. Now, the fascinating thing is where that comes into play and why it was such a big deal is at the early stage in early stage companies, there is actually debt that's used as a bridge financing. It's a bridge typically between rounds. And what's fascinating about it is it's actually really low risk financing. I looked at it, and the default rate is actually exceptionally low. It's like way lower than than anything else I've seen. And it's because at the early stage, the banks or the SVB knew that the investors are going to put the capital in to get it to the next stage. So it was a tool that was actually utilized. That's causing some problems, absolutely, in the US. And what it's really done is in the US caused the investors to rethink where they're putting capital. It's choking it down, and there's a bit of a freeze taking place. It wasn't so much in Canada because they weren't that active here. Canadian banks are not going to finance these early stage companies other than providing them a bank account. So how does it play out? There are now others that are looking to play that role. It was a good role to play, and you can make money at it. Will the money come back? Yes. Like the sub-debt crisis, we still have sub-debt in the US, so it still takes place. But it's causing this ripple effect where there's less capital being placed because we're kind of, it's a herd mentality. They're not putting capital at risk right now to wait to see how it plays out. And it falls into one of the questions. Interest rates are going up. So that's causing return issues, but now we're still seeing capital being placed. I think it's going to be a bigger issue for impact on can some of the funds raise their next round, which is a different question.
Danielle, do you want to comment on that?
I think overall, like, we're just not seeing that same impact in the earlier stages with angels. For me, a lot of founders have come forward and been concerned not only about Silicon Valley, but about the overall market and whether there have been changes. Certainly, valuations have dropped, which has actually encouraged more angels to participate in rounds where it was just becoming unfeasible, right? We were getting a lot of, and we still are getting a lot of these Y Combinator safes that aren't exactly investor friendly and don't really offer a lot of incentive to participate in this round, especially when it's not Silicon Valley where we're investing, right? So the kind of potential for follow-on funding and speed of growth are just not comparable metrics. And so overall, I think I see a lot of conflation around what's happening in one location or in one way, with the fact that it's just not affecting the individuals that I'm working with. So overall, the type of angels who aren't participating right now are the ones who are going to renovate their kitchen anyway.
Brian, any thoughts on this before we move on?
The only piece I would add to that is what we have available to here in Canada. You know, like if you're eligible for things like shred credits or any other sort of credits, there are debt vehicles that will finance that, because that typically comes after you file your taxes. So there are certain debt vehicles and companies out there in the Canadian environment that will finance you to get you to the next stage. But overall, I mean, whether it's a startup or a growing business, what has changed is companies now need to look at longer runways. But you've probably heard that already. You need to be looking at 18 months to 2-year runways rather than these shorter 6 to 12 months that people thought they could get before because financing was coming so easy. So it's a good thing because it's focusing companies to look more to the fundamentals when they're building it. Now, there is a difference on some of the deeper technologies, you know, where they know, like I've said, one we invested in, it's not going to be till 2028, 2029 before they're commercial. So there are some differences in certain sectors, but overall companies need to look at how can they go 18 months to even up to 2 years before they get funded again.
Yes, and investors seem to be skeptical if you're coming with a 6 to 12 month ask. They're asking about that right up front. So okay, so I want to get to some of the live Q&A questions here. Danielle, back to the data room. What stage do investors really want to see that full data room?
I guess, like, yeah, investors is a broad term. So comparing kind of angels to VCs, I would say angels could be any kind of range. I think it's never too early to start building your data room so that it's at least in a state that you can operate from, and then sharing it with any investor who asks. I mean, obviously make sure that you're even interested in them as an investor before you share your information with them. But I think that's really when, there's still those early stages. There's nuances around, what people are looking for. They may be just happy with your team and your deck. And then when you're getting into the VC stages, what you're looking for are more concrete metrics and the validation points. Looking for, if you're not leading, then you're looking for a signed term sheet. So a lot of the challenges we had at Ontario Centres of Innovation when we were doing due diligence is we had very specific criteria. The founders would say, yes, 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 we have all of that. Then we'd look in the data room and that term sheet wasn't signed, or that shareholders agreement wasn't completed or issued, that the financials were not even in a state that could be considered viable. There's a lot of challenges around financial models in the early stages. So it really does leave an impression when the things that you're stating are not accurate with the data room. So there's a lot of cross-referencing there. So make sure that you're prepared, that you've got your I's dotted, T's crossed, and that when you're stating those expectations and you're communicating that, you're communicating very directly and very honestly with your investors.
Absolutely. I would also add that investors have a much longer memory than a startup does about conversations they've had with you. So, for example, I make introductions for companies that have gone through our readiness process, and some of them will say that they haven't talked to folks. I'll make an introduction, and that investor will say, I talked to them on this date and told them this. And so, whether that's record keeping and contact management systems and the plight of being a startup, or, just good institutional memory on the part of those investors, they'll remember their first and second and third contacts with you, whether or not you do.
And I'll just add to that, because one thing that's a real pet peeve is when the associate has brought you forward and then you try to kind of go to the hierarchical piece and go to the partner. If you've already been rejected, then the partner will send it to the associate, and they'll even be more frustrated that you're kind of going over the head of their process. So just keep that in mind, not always to play those politics.
Great point. Okay, so that's the answer on the data warehouse. Brian, what are some of the top things that you look for when investing? And we'll do a roundtable quickly on this one, but starting with you, Brian.
For me, it's back again to that team.
Yep.
I'm looking for what's the founding team looking like, whether it's a single founder, 2, 3, 4, what's their background? Does their background, as to James's point, no, I'm not looking for your entire bio, but does your background lead to what you're doing? If you've had a background completely in finance and now you're going into carbon capture, like, where's the match, right? That happens so often. There's a mismatch between what you want to do and what you're presenting. Is that team coachable, right? Are they open to? They have to have their own direction. They have to be able to move ahead. But are they coachable? Are they open to suggestions? Are they open to talking to different strategic partners? Have they talked to potential customers? That's a number one mistake I see with teams over and over again. And Foresight does an amazing job through your programs of getting them to do that. Oh, I've got this great solution, it's the best thing since sliced bread, but they haven't asked a single person whether or not they're interested in it. And more importantly, would they pay for it, right? So having had those customer discovery calls, at least got a feel for what's out there, is critical when I'm looking at investing into someone.
Great points, Brian. James, over to you.
Yeah, this is going to sound funny, but I'm going to keep what he said. What I find fascinating is I like to call this, we get shown the Field of Dreams business model. If we build it, they will come. And cool movie, good movie, but it was about dead people. Not a great model to build companies around. What I want to see is, as Brian said, can the team, some things that help to check on this is, one, it's not a bad thing if you've blown something up, right? like if you've actually, I used to not invest in anybody unless they actually had failure, because this is hard. And having the arrogance and thinking that, yeah, you know it all, it goes to Brian's point about coachability. You think you know it. No, you don't. Like, we don't know, frankly, anything. And the more you do it, the less you know. So the point about it is, I like to have two questions. So what's the problem you're solving? Okay, I don't need 12 questions. I don't need all this. What's the problem? Who owns that problem? And I'm not talking, well, the industry, like clean tech. Well, so-and-so, whatever. No, show me the individual that has that quote unquote bleeding from the neck problem that you're going to solve, and that they are prepared to pay for, to, again, Brian's point, that they're actually, because otherwise, why are we doing this? And, we can deal with business models. We can deal with all sorts of other questions later on, like what business you're in. But who is that? And then show me 75 more of those parties that I can actually build. Like, forget this TAM, SAM, all of those things. No, do that. Anyway, that's it.
So rejecting a couple acronyms for good old customer discovery. Danielle, your thoughts?
Yeah, I mean, I guess the important philosophy to understand is that if it's not an enthusiastic yes, it's a no. And there's so many maybes in the middle there, and sometimes there's not even a good reason for it. It's just, you can see that, like, kind of those barriers to entry, those risks, and they're just too great. And so I think what founders need to know is, the things that they're saying or the ways that they're portraying themselves that are kind of red flags or indicators that we're looking out for. A lot of what I see is kind of like a bit of that naivete, right? So if you say things like, we don't have any competition, or we have first mover advantage, well, that just, it's not like you're always going to be naive. It's not that I don't want to ever hear from you again. It's just, to me, that's an indicator that you have some lessons you still need to learn about the fact that first mover advantage can be first mover disadvantage, and that if you're out marketing yourself, you have a steep marketing challenge in front of you. Or if you think you don't have any competition, look again. And if you don't, there's probably a reason. So do I want to go through that process with you of learning all of these hard lessons, or are you actually going to get there quickly and come back to me with something interesting? And then a lot of other things that founders say around, kind of idea related or patent related. I'm looking for, are you ready to commercialize? Are you ready to put in your time and effort to really execute? And so a lot of the things that founders say that don't indicate that they're really ready to position themselves in the market and fight for that market share, I'm looking for those things. So when we say founder, there's so many things that go into a good founder, and being an entrepreneur isn't for everyone. It's an exceptional case. And I think in many ways it can be learned, but through a few hard lumps. And so for me, it's like, where are you on your path, and are you going to continue on this path? And if I can see those, then it might be something worth kind of digging in early, but then also recognizing that you have to be excited. You have to be ready to go on that long journey with the founder.
Super valuable insights all around, and we could go and circle back on this question alone, but we do have some other great ones. So I think we'll leave that one for now. And if there's other thoughts that you want to share on this, maybe we can circulate those with the follow-up email to this session. So the next question is, it seems as though we frame success in the climate ecosystem through exits, going public, and money raised. I very much understand that investors need to make money, but I'm wondering what other data points we could use to help frame success, such as systems deployed. If we are going to solve climate challenges, we need some additional ways to frame success besides just exit. Thank you for your thoughts. So how else do you measure success as a clean tech investor?
I'll take that one a little bit. I mean, I'll go back for a second. As an investor, you have to have a way to be able to make money off of it, right? So even though, this person's saying, well, we can't just look at exits or going public, if there's no way for investors to get their money back out, that's not the game that they're in this for, right? So there are other vehicles out there. There's grant support. There's other vehicles, nonprofits, for doing this. So I've got to remember, only about 5% or less of companies are truly venture backable, right? So you've got to start from that point. So this is not going to be the solution for, the climate crisis and doing all that. There's a number of different vehicles and options out there that are going to have to be deployed to solve the climate crisis. But, here we're talking specifically about the investment ecosystem. Yes, we will measure in terms of in the companies we're looking to invest in, amount of CO2 deployed, number of underrepresented founders supported. We have our some key metrics that we want to see on top of making the money. But if there is no opportunity for a return to the investor, then it's not something that we could do with this vehicle, and you'd have to look at some other model.
I think that's a pretty comprehensive answer on that one. Thanks, Brian. With high interest rates, looming recession, banking troubles, and so on, how has this impacted how you value companies? What risks are you willing to take?
Well, I'll just start and just kind of follow on from what Brian was speaking to, because I think it plays into the same answer, which is the end of the day, like there's always good deals out there. There's especially actually when times are tough and people are really ready to be scrappy. And so for me, a lot of it comes down to like, are you actually building something that people need? Is it a need to have, not a nice to have? And so that kind of like creates just I guess less leeway for failure in these types of markets. And so we're still looking, but we're just creating a narrower path to say, okay, show me your traction, show me your validation. What have you actually built? What is your MVP? What is your user growth? What is your revenue growth? What key milestones are you hitting? And what is your unfair advantage and sustainable competitive advantage? And all of those also play into the metrics that we're looking for. And so I think that's always important to keep in mind, but it just becomes all the more kind of narrow and focused in these times.
Great thoughts, Danielle. James or Brian, any other comments on that one?
No, I think they've absolutely covered it. I agree totally with Danielle. A good deal is going to get funded. But tell me a good story. Show me your passion. Show me, and the thing is, there's risks in all. Like the whole point about all of this, there is risk, and so that's not the problem. You not understanding that is a problem. You trying to couch it and say and put it in, like, remember, working with investors is about, in my opinion, it's about engagement and building trust. So it's building that relationship. To Brian's earlier point, you are going to work together. And what for investors, actually, let's put it from the entrepreneur's perspective and personal experience. Sometimes the hardest deal you did was the fact that you actually walked away from a term sheet because I don't trust the investor. Okay, and that happens. There's good, just like there's good teams, there's good and bad teams, there's good and bad investors. So you have to do your due diligence, make sure, to what both Danielle and Brian were saying, there has to be that alignment, right? It has to go two ways, because you have to spend that time, and your objective is to take the company from where you're at, scale it, get to exit. And it doesn't have to be an exit where you sell it to another company or whatever. Frankly, right now, the number one exit for teams is secondaries, right? It's not actually like there are IPOs, and if an investor, one of the entrepreneurs tells me, well, they're going to exit by IPO, I immediately start putting that into that. I don't think they know what they're doing, because they're not getting to the scale. They're not going to be like, I've got one that showed they're going to IPO in 18 months. I'm going, really? No, that's not happening. So you lose that credibility. Know what you're doing. So anyways.
Okay, thanks for that thought. Yeah, that credibility is quickly lost, I would say, and hard earned. So on challenges with financial models, what are some of the biggest challenges that you regularly see? And conversely, what are some of the best practices or minimum requirements for financial models?
I mean, to me, when I'm looking at financial models, it's how well is that backed up? I mean, people can throw out numbers, but some of the points that James was making earlier, do they really understand their industry? Do they really understand what's behind those numbers? If they're showing, yeah, they're going to go to IPO in 18 months, yeah, way unrealistic. So for me, the financial models is anything that goes in there, you have to be able to substantiate. You have to be able to show, Danielle was talking about your data room being ready and having all those things. Those are the key pieces. Everything in that data room has to be able to support your pitch deck and has to, and your growth, and has to be able to support your financial model. So, this is what we're looking to charge customers, and we've talked to X number of customers, and we've done surveys, and we've tested it, and we know people will pay this. Now that's gone into the pricing part of the model, right? We know that the problem is this big. How well do you understand the problem is critical, so you can substantiate how big that market size is going to be. So the financial model is all about having the backup to it and being able to support what you've put into that model.
I'll just say quickly, I've seen pre-revenue companies generate entire integrated cash flow forecasts, and I'm just like, what does this even mean, right? Like, have you even, what are the assumptions that you're making? What are you actually building? What is this actually telling me, right? What are these numbers communicating to me? And so that's the part where, sometimes people go almost too fancy. Sometimes people don't project enough. A lot of women entrepreneurs will come to us with and say and caveat it with, these are very conservative projections. Well, I don't want to see conservative projections. I want to see your projections. I want to see your big vision, and I want to believe in it with the assumptions that you're communicating to me. So there's a wide range, and you're really trying to kind of get to that same understanding. And I think that's an indicator of a lot of these things, right? Like, what is your range for your valuation? What are your term sheets? What are all of these things telling me about your perspective on your own company? And, I don't know how much detail you want us to go into, but, I'd like to see balance sheets balance. Those kinds of things are important too.
For me, this is about, when you look at it, we can either debate the business and you lose, or we can debate the assumptions upon which this is built. And then you're going to win, because if you're debating the assumptions, we know they're wrong. Okay, so everybody knows that. It's just matters of degrees. And yeah, one of the things that you often see is entrepreneurs sending out decks and things, or it's just a revenue projection. Well, that means nothing. To Danielle's point, how many customers? What's the pricing? What are all those key underlying points that enable me to understand, well, where's the risk? And I think this is, so often we don't do a business plan. Why don't we do a business plan? Because, well, no one's going to read it anyways. Well, it's not for them, it's for you. Do you have an idea where you're going? What does that turn out as far as financial projections? What does this mean for the company? And bang on, Danielle, when you look at this conservative projections, no, how do you get this company to show me a path to $100 million in revenue? Right. Show it. What would it take for you to do it? Oh, I'm going to get to $150 million in revenue, and I only need 5 employees. Pardon? So all credibility is just lost, right? You don't understand what it takes. And that's the important thing on these projections. Do you know what it takes to get from where you are to, and how much capital is going to take? Not for the project which you're financing today in the step. Tell me what the plan is, working backwards. What are we doing now? And to their point, I can't finance. I'm not going to answer any questions in 6 months. So let's be realistic here. I need to finance for a realistic period where I'm moving the company from one step to the next.
Super insightful. And, you know, we could dive in on all of these topics. Instead, we're going to do a 2-minute lightning round. So each of these questions gets one response, and I'll give you 30 seconds. So you can pick your question. So first come, first serve. The first question, team is important. What are the things that get you excited about the team or other things?
Excitement and passion for what you're doing.
Okay, thank you very much, James. In the clean tech space, what do you consider to be the greater need? Offerings that increase distribution, adoption, scalability of existing technologies, or creation of new technologies?
I'll jump on that one. To me, it really doesn't matter. If you look at the models going forward, the carbon pricing is what's going to have the biggest impact on changing us getting to, keeping below 1.5 degrees, if we can even do that. And so technologies that truly show something that we can reduce GHG emissions, that you can maybe sell those as carbon offsets, are probably things that are going to have the biggest impact on the climate crisis. So that would be, so it doesn't matter which way that comes at it, but that's where it needs to come at.
Excellent. Danielle, any thoughts on that one?
Like, I agree with them both. So you've got a great paneling here, Leslie. Definitely wouldn't be and/or. And then I completely agree. We need to see that passion coming from the entrepreneurs. And I love deep subject matter expertise as well, because it just shows me that they've been focused on an area for so long. They're giving those insights and they're building something that hopefully will change the world. And we need a lot of those solutions to improve the climate.
Thank you so much. Final lightning round, your takeaway for our venture assume founder-ish audience, founders plus others. What do you want them to know about raising a round right now?
I'll just kick off to say, I think it's important to know that there's a lot of pathways to success. And so being able to meet and connect with different individuals, tap into their own networks, find high net worth individuals, whoever is willing to agree to, your terms, your valuation, your kind of stage, and wants to buy in early, that could be a great champion for you and get you to that next stage.
Thanks, Danielle. Other thoughts? Final takeaways?
Where we are in the cycle doesn't mean that there's no capital available. Capital's available. It just means it may be coming from other players. When prices come down, other players get more excited about coming in. Corporate VC, with all the caveats that I normally put on that, they're more active. But make sure when you're communicating with them, you're showing not just on your team. It's not just about the product. It's not just about the technology. It's the technology and the business. Both sides have to be there. Show it.
Thanks, James. Over to you, Brian.
The last piece I'd add in is you don't have to measure your success by how much money you've raised. Look at the fundamentals of your business. Some of the great companies have got bootstrapped the whole way, so it's not just about raising money. Make sure that the fundamentals are there, the business is scalable, the business can grow. I know that doesn't always apply in deep tech, which needs the investment, but don't just look as raising money as a success measure.
Awesome. Great advice. We are right at the end of our time. This was incredibly insightful. Thank you all so much for sharing your expertise and the hard-earned lessons in this work. So on behalf of our audience, a huge thank you. I want to thank also everyone who joined us today. So that you're aware, our next session will be on May 16th, and the topic is HR incentive plans. I don't have a list of the speakers for that one in front of me, but if it's anything as good as this one, then you will have the best employees that you can get in your startup after that session. So hopefully you'll join us on May 16th. Thank you so much to Danielle, Brian, and James. Really, really appreciate your time today. Feel free to connect with folks on LinkedIn. Feel free to reach out via email, and we'll hope to see you at the next one. Have a great day, everyone.